Hi, I'm Mark Hebner, President of Index Fund Advisors, and welcome to the Quarterly Market Review for the second quarter of 2019. Each quarter, we like to look at indexes around the world and see how it's done during this last quarter. So here's some of the data. In the U.S., we had stocks up about 4.1%, which is a pretty healthy quarter. We had international developed stocks come in at 3.79%. Emerging markets was a little on the low side at 0.61%, while the global real estate market came in around 1.3%. U.S. bonds had a good quarter, up 3%, while global bonds were up 2.75%. We also like to take a look at the news that moved markets during each quarter. And so here, let's look at some of the headlines. You saw early in the quarter here, U.S. stocks rallied to put the S&P 500 and NASDAQ at new record highs. Then we had a little slide here because the U.S. and China trade talks ended without a deal. We also had U.S. consumer sentiment hit the highest level in 15 years. Later in the quarter, we had U.S. job openings outnumbered unemployed individuals for the widest gap ever that we have on record. And then near the end of the quarter, we also had the U.S. economy grow at about 3.1%. And we also had S&P hit another record close after the Fed hinted it would have interest rate cuts. We also like to look at the global breakdown every quarter. I think we've been doing this since 2012 now, once a quarter. And if you go all the way back to 2012, you would see that this has not changed much at all. The United States makes up about 55% of the total market capitalization, which is $53.4 trillion at the end of this quarter. International developed markets makes up about 33% of that global market, and emerging markets make up about 12%. So part of the reason we do this is to remind investors about the random walk of asset class returns and why it would be futile for you to look at one quarter return and think it's going to repeat itself or even reverse itself or have some kind of pattern from one quarter to the next. And so let's take a look at the two quarters here and see how they compare. Let's back up one quarter to quarter one of 2019. And we've put the asset classes in order of those with the highest return on top, those with the lowest return on bottom. And we saw that the real estate index, it's actually a global real estate index, came in with the highest return of 15.2% just for that one quarter, which is a very high return. U.S. large companies also came in quite high at 13.63%. And then the one-year fixed income, as we would normally expect, came in with the lowest return of 0.77%. So obviously, if we look at this pattern, and we hold these positions the same as they were for the first quarter and look at the returns for the second quarter, we can see a very different return organization, basically a random walk of the returns. We saw here that real estate, from having a 15% quarter, dropped down to a 1.8% return quarter. U.S. large company was 13.6 and dropped down to 4.3. International small value, just to pick one out, had an 8.65% return, but then dropped to almost flat at 0.15%. So it should be very clear that there is no predictive value from one quarter return to the next quarter. So let that go, please. Now, a much more intelligent way and a more logical way to look at returns from one quarter to the next is to think about them in whole, globally diversified portfolios that are risk-based. So highest risk being the 100% stock allocation that you find in Index Portfolio 100, and the lowest risk being a 10% stock allocation. And now we see ourselves a nice, neat pattern where in the first quarter we had 11% return for that global equity portfolio. And if you dilute that with fixed income, you see it went down to 1.89. Well, in the second quarter, we still had a positive return for equities. So we still had the highest of those returns come in at Portfolio 100, albeit relatively small at 1.65, at least relative to the first quarter. And Portfolio 10 coming in at 0.72. And now we can see ourselves a nice little pattern. But we shouldn't even talk about or focus on short-term returns like quarterly returns, especially when deciding how to invest our long-term or even short-term money. Instead, we should look at the full population of data that we have. And we actually are now at 91 years and 6 months. Our IFA index data and index portfolio data goes back to January 1st of 1928. If you have any questions about that, on our website we have a new button in the top right corner called backtesting disclosures and index descriptions. And I highly recommend that you visit that and read through those to see how it is that we come up with this historical data. But here we see the full equity portfolio if you had invested $1 on January 1st, 1928, and you hung in there and rebalanced it on the first of each year, which is nobody did because we didn't even have all these funds back then. But had you tracked those indexes, $1 would have grown to $13,849. And by the way, that's net of mutual fund fees, the current mutual fund fees, and net of a highest advisory fee. So not too bad of data, not too bad of number for you to think about in terms of long-term returns. If I dilute that 100% equity portfolio with 25% bonds, then I would have a portfolio of 75, and you can see that that came in at $4,752. And if I just bought a really low risk, actually zero risk in most academic definitions, and bought a 1-month US Treasury bill, that only grew to $20 over that whole period, which if you take out inflation, that's pretty close to zero. So that wraps up our quarterly market review for the second quarter of 2019. And stay tuned for my new segment I'm going to be doing about understanding uncertainty. We'll see you then.